So in this video, I'm going to tell you about top 10 trading mistakes that trader makes in this recent time. So before you will go on to the video, please just subscribe to my channel. If this is the first time you're coming across this channel, please subscribe and then hit the notification bell button so that whenever I upload video, you'll be the first to see and take action and learn the processes that are within the video. So let us just dive right into the video. Right now the first trading mistake that a lot of traders make has to do with not making enough researches into the market. All right, a lot of traders just, most people go into the university. Let's understand this properly. Trading is like a career that most persons whom have understand this career very well are doing really good. They are doing excellently. All right, so why would somebody come into trading within a day or a week and then they expect to be making massive profit within a week? Or if you're a mechanical engineering, you just decide, okay, I want to be a mechanical engineer today, and the next day you start fixing cars, making drawings, fixing generator. You have to spend some time learning it. All right, you have to spend some time studying the course, studying the subject matter, studying the career, and then getting better. So most persons don't study the trading career well enough. They don't make enough research into the market, and they just dive right into the market and then sweep away some money and then come back and say trading is a scam or trading is a gambling, or they will have one or two names to give trading. All right. Now the second mistake that a lot of traders make is trading without a plan. Every financial institution or every organization or every country, they have there's what we call a plan. All right, a plan is a guideline. It's a plan entails a goal like that you attain. All right, personally, I've been trading for some time now, and I know how my trading career went when I traded without plan, and I knew how it skyrocketed without, as in when I had a plan. All right, I have a trading plan, and then when I trade, I have a daily goal, I have a weekly goal, and then I have a monthly goal. And it was very easy to achieve a very large volume of goal, like a monthly goal, like a monthly kind of a goal, when it was split into weekly and daily and hourly. So if you are trading and then you don't have a plan, you are invariably just gambling your time away. You should trade with a proper plan and then stick to the plan, and know when not to stick to the plan and know when to stick exactly to the plan. Because when you stick to a trading plan, the chances of becoming successful is very, very high. Trust me, it's very, very high. All right. The third mistake that most trader makes, all right, is failing to cut losses. All right, and that's, if you check one of my ebook, the art of trading, I call that being greedy. All right, most persons, when it's time, when the market decides to go against them, all right, maybe probably they make mistake with their entry point, or and then maybe something happened, or they miscalculated, and the losses is going in. Most persons just leave it like that, and they will be hoping that the odd will become uneven. All right, meanwhile, in most cases when it comes to trading, it doesn't always work like that. When there's a bull run, it moves like at the speed of light. If you are trading against that bull run, then you end up losing a lot of money. So most persons fail to cut losses when it's necessary, or to take profit when it's necessary. All right, don't be greedy in the market. Don't go into the market with greediness. Then, so while we talk about the other points in great analogy.
At this point, if you are not yet subscribed to my channel, do that now for more contents like this. Also, enable the notification bell button so when next I upload a video, you'll be notified. Like this video, comment your thought and share to friends and family. Let's continue. 3. Overexposing a position. A trader will be overexposed if they commit too much capital to a particular market. Traders tend to increase their exposure if they believe that the market will continue to rise. However, while increased exposure might lead to larger profits, it also increases that position's inherent risk. I have included below links to a professional Forex trading school. Build a career with it. Investing in one asset heavily is often seen as an unwise trading strategy. However, over-diversifying a portfolio can have its own problems, as explained below. 4. Over-diversifying a portfolio too quickly. While diversifying a trading portfolio can act as a hedge in case one asset's value declines, it can be unwise to open too many positions in a short amount of time. While the potential for returns might be higher, having a diverse portfolio also requires a lot more work. For instance, it will involve keeping an eye on more news and events that could cause the markets to move. This extra work may not be worth the reward, particularly if you don't have much time, or are just starting out. That being said, a diverse portfolio does increase your exposure to potential positive market movements, meaning that you could benefit from trends in a lot of markets, rather than relying on a single market to move favorably. 5. Not understanding leverage. Leverage is essentially a loan from a provider to open a position. Traders pay a deposit, called margin, and gain market exposure equal to as if they had opened the full value of that position. However, while it can increase gains, leverage can also amplify losses. Attention, I have also provided a link of verified FOREX signal software that could help both beginners and professionals make quick decisions on the market. Trading with leverage can seem like an attractive prospect, but it is important to fully understand the implications of leverage trading before opening a position. It is not unknown for traders with a limited knowledge of leverage to soon find that their losses have wiped out the entire value of their trading account. To avoid this mistake, you should get up to speed with trading on leverage by using our What is Leverage guide. 6. Not understanding the risk-to-reward ratio. The risk-to-reward ratio is something every trader should take into consideration, as it helps them decide whether the end profit is worth the possible risk of losing capital. For instance, if the initial position was £200, and the potential profit was £400, the risk-reward ratio is 1 to 2. Typically, experienced traders tend to be more open to risk and have suitable trading strategies in place. Beginner traders may not have as much of an appetite for risk and could well want to steer clear of markets that can be highly volatile. Regardless of how open you are to risk, you should have a risk management strategy in place during your time on the markets. 7. Overconfidence after a profit-winning. Streaks don't exist in trading. The euphoria that comes from a successful position can cloud judgment and decision-making just as much as running losses. The buzz from a win could lead traders to rush into another position with their newfound capital without carrying out the proper analysis first. This may lead to losses and could potentially wipe out the recent gains on their account. Sticking with your trading plan can go some way to combat this. A profit suggests that a plan is working, and should serve to validate your previous analysis and predictions rather than act as encouragement to abandon them. 8. Letting emotions impair decision-making. Emotional trading is not smart trading. Emotions, such as excitement after a good day or despair after a bad day, could cloud decision-making and lead traders to deviate from their plan. After suffering a loss, or not achieving as good a profit as expected, traders might start opening positions without any analysis to back them up. In such an instance, traders may add unnecessarily to a running loss in the hope that it will eventually increase, but it is unlikely that this will cause the markets to move in a more favorable direction. Therefore, it is important to remain objective in your decision-making during your time on the markets. To cut out emotions from your trading, you should base your decisions to enter or exit a trade on fundamental and technical analysis that you have carried out yourself. 9. Depending on a fail software. While trading, it is not wrong to operate with high sophisticated software, but it is wrong to depend on fail software. Hence, I have provided links to some authentic signal software in the description of this video. Check them out. 10. Lastly, no career mindset. Seeing trading as a gambling platform automatically reduces your professionalism. In fact, even a gambler understands his gambling as a profession and that spores his successes in it. You have to look at this as a career. Take advice from truthful and successful traders and not those who have never made a dime from trading. Conclusion: make your own trading plan and stick to it. Every trader makes mistakes, and the examples covered in this article don't need to be the end of your trading. However, they should be taken as opportunities to learn what works and what doesn't work for you. The main points to remember are that you should make a trading plan based on your own analysis, and stick to it to prevent emotions from clouding your decision-making. Subscribe to this channel for more videos like this. See you in my next video.